Hello there, everyone, and welcome to the Final Bar. It's Thursday, March 14th. I'm your host, Dave Keller. I'm the Chief Market Strategist here at Stockcharts.com, coming to you all this week from New York City. I've had some really good discussions with mentors, with people that I know in the industry and other contacts here in the New York area. It's been a really good, productive week with some great thoughts, some good market discussions, and a lot of other things about life and other things as well. You know, it's interesting as we're looking at the market today. I think one of the key takeaways that I am observing two things. Number one, energy leading the way higher. While pretty much everything else was down today, energy sort of pushing their way to the upside. And the VIX, which spiked up briefly over 15, which as you probably remember, that's the level, that's that line in the sand we've been talking about. That really separates a low volatility environment from a high volatility environment. We did, in fact, spike above 15. My phone lit up with a Stockcharts alert on via text about an hour ago or so, letting me know that it happened. I came back to my room and fired up the laptop to dig into it, and the VIX had already come back down to 1440, which is where it ended the day. So still a low volatility environment, but certainly showing some signs of a corrective move. I think you're certainly getting the sense that something is changing here on Wall Street. The major averages remain fairly strong and still in a primary uptrend, but I think showing a lot of rotation underneath the hood. With that in mind, let's get to our market recap and focus on how the markets played out through the course of the day today. You know, looking at the S&P 500, the Nasdaq Composite, the Dow, very rare that all three of them are almost identical, but that is exactly what we observed here on Thursday, March 14th. All of them down about just under 1/3%, right? The S&P was down about 15 points. That's 5150, that is. Great Van Halen album, by the way. But we digress. So 5150 is the close for the S&P 500. So still obviously well above that 5,000 level. But again, just showing signs of at least a pause in this remarkably strong uptrend we've observed so far. Mid-cap S&P 400 down 1.25%. The S&P 600 small cap index leading the way lower. That actually finished lower 1.6% to 1281. The VIX, as I mentioned, spiking higher briefly through the course of the day, and in the afternoon around 3:30, it was up just above 15. That's where I got an alert. That's when I was thinking, all right, this is a spike in volatility. This is what we've been talking about. This is that warning sign. But you really have to wait for the close. And had a breakfast this morning with one of my mentors, Jeff Weiss. I learned so much from Jeff over the years, primarily how to just lift up those around you by having a joyful perspective on life, which Jeff definitely does. But also to be patient and wait for daily closes and weekly closes and even monthly closes. And don't get too excited about the noise that happens from one close to the next. Focus on the directional takeaway from one close to the next, whether that's on a daily time frame or a weekly time frame. So even though we spiked higher, I think the VIX ending below 15 is the real story. That tells you for now, volatility remains fairly low. 10-year yield and the others, parts of the yield curve here, for the most part, pushing higher today, in some cases by quite a bit. You can see the 10-year yield finished today right around 4.3%, 5-year point right around the same, and the 30-year point is around 4.44. Of course, when bond yields go higher, that means bond prices are going down. And so the TLT, which is a bond ETF that we track, down about 1.5% today. So, you know, very much a move lower there. The dollar index was up about 0.5%. It's probably the biggest update we've seen in the UUP. That's a dollar ETF in quite some time. The dollar's been almost a non-issue here recently, but pushing higher today. Commodities basically mixed. The energy side of commodities like crude oil, natural gas, all up. And the USO, which is a crude oil ETF, was up 1.6%. Gold and silver prices slightly lower. The GLD was down about 0.4%, still holding steady above $200 a share. Looking at Bitcoin, Ethereum, and the other top 10 cryptocurrencies, all rotating downward. So while equities actually held their ground pretty good, very much a risk-off move in cryptocurrencies. And to be honest with you, it's been a bit of a disconnect. There are times when stocks and cryptos have moved very closely, have been very strong positive correlation. Now I think we're getting very much the opposite. We're actually getting a bit of a distinction between those two asset classes. Bitcoin down about 3.6% today, still above 70,000, but we'll call it 70,500. This is after briefly getting above 73,500 in the last 24 hours and rotating lower. Ether prices down over 4% today. Looking at the 11 S&P sectors, you can see that energy certainly winning the race today, up over 1% for the XLE. Higher crude oil prices are really the story there, I think, more than anything. Excuse me, I don't have the latest crude oil futures, but I would imagine today's move on the USO would mean that the spot crude oil or crude oil future, that current contract, is probably above $80 a barrel. And that's that level, that line in the sand we've been talking about for quite some time. Technology actually finished number 2 and was basically flat for the day. In communication services, the XLC was down about 0.25%. On the downside, you have 2 of the most defensive sectors, and the third most defensive one was right below that. Real estate, utilities, consumer staples, 3 of the bottom 4 performers. Real estate was the worst, down 1.4%. Financials and utilities were actually tied for number 2, and consumer staples right around the same, right? About down 0.8% for all of those. On today's close, with the drop that you saw in small caps, the Russell 2000, the IWM is the ETF we track there. The short-term model is actually starting to turn negative. Now, I don't formally update my market trend model until Friday's close. So you really wait during the week to lock in an official change. But if the week ended today, if today was Friday, the short-term model on the small cap ETF would actually turn lower. And that might be something to watch here, because usually, to be honest, at major market tops, small caps will tend to drop first. Then you will find mid caps and then large caps follow through. And that's because equity investors are usually getting a little more defensive, a little bigger, a little more tried and true companies taking some risk off. And that usually hits small caps first. So for what it's worth, that's what we're seeing here today. Just to finish off here, and sorry for going through a zoomed-in version of our dashboard, but I do want to get to the Magnificent Seven and Friends playlist that we like to follow. If you look at the top of the list, Microsoft, Alphabet, both up over 2%. Tesla, NVIDIA, both down over 3%. We've talked about sort of this disconnection or this diversification or dispersion, whatever adjective you want or noun you want to use to describe this. But basically, the Magnificent Seven are not one homogenous group anymore. I think we initially saw Tesla break from the pack, then we saw Apple start to break down while the others were holding up. Now they're kind of all over the place. You're half and half, with some of them higher, some of them lower. But the losing names in this group, that really hurts, right? Tesla down 4%, making a new 3-month low again today. NVIDIA down 3%. Still not a bad chart, but certainly changing from that long and strong up and to the right, onward and ever upward type of pattern. Not what we're seeing on some of those growth names for sure. Continuing on here with our market recap, I want to look at the S&P 500 daily chart. As you look at this chart, I was talking with one of my conversations today. We're talking about divergences and how, what you're noticing on the chart of the S&P, at least what I'm noticing on the QQQ, what I'm noticing on a number of individual names, is this bearish momentum divergence where you have higher highs in price February to March, lower peaks in momentum. It is a clear divergence. It's almost a textbook divergence, to be honest with you, which, again, is very common at major market tops. I'm going to, mention later our upcoming webcast coming up next Tuesday, March 19th, with market misbehavior, called the Market Top Checklist. And one of the leading indicators, one of the items, one of the 7 on the checklist is basically some bearish momentum divergences. You usually see quite a bit of them, not just on the major averages, but on leading names, on a lot of stocks in different sectors. You'll see those divergences. What that usually means is whatever buying power has propelled the market higher and higher is starting to alleviate. It's starting to change. You get a bit of a change of character. There's no guarantee of a top, right? This is one of those leading indicators that tell me, all right, we're starting to see those conditions of a top. To really confirm a top, that's the other things in the checklist we'll get to in that webcast that I mentioned. But, one of the things I would certainly be looking for is breaking to a new swing low, right? An uptrend is a pattern of higher highs and higher lows. That is certainly what you can use to describe the S&P 500 since the October low last year. If that would change, then the character is certainly changing. 50-50 is that level that I'm looking at here, which is this pivot point from the early February swing high, sort of these late February, early March swing lows. We break that, I think this is a different market altogether. The momentum, again, has been drying up here. It's a bit of a concern. Overbought in mid-February, not overbought here as we're trying to make new highs in the last week or so. And that could be a danger sign that many have been waiting for sure. I do want to briefly look at the chart of the VIX, excuse me, just to sort of, think about the overall implications here. As a reminder, VIX above 15 for me is sort of that warning sign that conditions are deteriorating, mainly because a spike in volatility usually only happens when, investors don't get a little nervous and a little anxious and start slowly and calmly buying stuff, right? The anxiety level rises, the fear level rises when people get nervous and they start selling. And so that's why a spike in the VIX usually coincides with a drop in stock prices. We did briefly get above that 15 level, as we have a number of times here in the last month or so, but we did not close above there. And I think until we close above 15, I think it's still wait and see mode. Still, by my definition, lower volatility. If you caught yesterday's episode, one of the 3 and 3 charts was looking at, the VIX sloping upwards as the S&P has been sloping upwards. That usually is not a good sign for stocks. That usually means volatility overall is starting to trend higher. You can see the shape of the 50-day moving average sloping upwards. Certainly something I am watching very, very closely. To finish off our market recap here, we're going to look at crude oil prices. A couple of ways to look at crude oil. USO is the crude oil ETF, which I like to look at during the day because it's a real-time ETF, so easy to pick up on that action. Here's the crude oil front month contract. We do have today's close update, and you can see we did close well above 80 here, around 81 and a quarter. So, one of the things we've been talking about is, do we see a spike above 80? Energy stocks have started to improve. I know when I was scanning for stocks making new swing highs yesterday for my market misbehavior premium members, we talked about how energy names certainly coming up in those screens quite often. But until crude oil gets above $80 a barrel, I think that's a tentative position. I wouldn't feel great about, buying into the energy trade too much, because that is really usually a very direct play on the price of crude oil. And you really want to confirm that crude oil prices are pushing higher before you go thinking energy stocks are a great idea, because the performance is tied so closely to one another. I think today you're getting that break above 80. I'd love to see if we get some positive confirmation, some sort of follow through on Friday's session. But overall, the price is improving, the momentum is improving. I think that tells you that energy stocks start to become an option you want to think about if you've not thought about it. Now, the XLE is getting very close to previous highs. I'm actually going to adjust or unadjust the data, that is. So on our platform, we default to adjusted price data, which adjusts for dividends and splits and all that. If you're looking at something that's a little higher yield than energy stocks, financial stocks, utilities, REITs, these are things that tend to have a pretty decent dividend component, a decent income component. When that's the case, I like to put an underscore before the ticker, because what that does is it actually looks at the real prices that are going back, right? Where did the stock or ETF actually trade in these previous points? So if you're really trying to line up with some support and resistance levels from quite some time ago, you probably want to use unadjusted data. So put the underscore before the ticker. On sharp charts below the chart, you can actually click this guy right here that says adjust for dividends. Make sure you uncheck that and you'll get the same result. Now, the XLE gapped higher on Wednesday's session, did push higher a little bit here today, closed back above 90 for the first time since October. Now, I would say we're really within a rounding error of those previous highs, which have all been in sort of that 93 to 94 range. We're kind of right there. So powering through that, all of a sudden, that's a big new high for multi-year high for the XLE. Now, you are seeing some patterns here on some of the individual names. One of the biggest top 10 gainers, I think, in the S&P today was Halliburton, which is up about 3%. Nice higher low here. It's not really a perfect head and shoulders bottom because you have an upward sloping neckline, but I would say it's certainly a higher low. And now we're back above the 200-day moving average. We're just pushing above that late January high, which I think is pretty important as well. So keep an eye on that and other energy names. Use our scan engine to find the ones that are breaking out, making new highs, by the way. Speaking of new highs, Microsoft there. So, how bearish do you want to be when a $3 trillion market cap company is making new highs? The answer is not that bearish, but it's worth noting Microsoft very much feels like a bit of an outlier on a day like today, up over 2%, while NVIDIA's and others are actually pushing quite heavily to the downside. But Microsoft really starting to separate itself from the other, formerly Magnificent Seven stocks. Continue to make higher highs and higher lows. Microsoft recently in a bit of a consolidation pattern. I think that pattern has now resolved to the upside, closing above 420 today for the first time. Alphabet, GOOGL, is the ticker that we look at. The C shares are GOOG. They're pretty similar, to be honest with you, but I tend to use the A shares as the primary charts that I'm looking at. Alphabet not as strong as Microsoft, and that Microsoft has made a new high, and Alphabet's certainly well below it. But look at the bounce off of the 200-day moving average. Now getting back above the 50-day. I think that's a really nice outcome after it was looking a little bit concerning not too long ago. Not too bad in consumer staples. There are actually a number of consumer staples names showing some strength here. Tobacco names actually having a pretty good move higher. This is Altria Group, ticker MOPM. Philip Morris is the other name to look at here. Bit of a divergence between the two. Philip Morris actually gapping lower today, or actually just trading lower. And Altria Group trading higher, but did really push above that 200-day moving average after all these failed attempts to do so, and now really pushing to the upside. We have a lot of overhead resistance right around current levels, which I think is a bit of a concern, but overall certainly seems that the path of least resistance is up until proven otherwise, or as I like to say, innocent until proven guilty. Tesla, let's look at some names actually breaking down here. Tesla making a new 3-month low, and it may even be worse than that. We're down back at the April low, and that was a level that we've talked about as a potential downside objective. I'm sorry to say we have actually gotten there. Now, if you think of this as a bear flag, which I think is a fair labeling, actually means some further downside, kind of down on the 140-ish level, if I remember right. But overall, certainly showing some weakness today. Interesting to see if we get a bounce off of that April low, which is right around 155, we'll call it. But we're pretty much there and have reached that downside objective. Some home builders struggling today. Lennar actually down over 7%. Now, this is a stock that made a new all-time high yesterday, right? So we're not too far off of all-time highs, but we came down hard right to the 50-day moving average. I think this is an important name to watch tomorrow and into next week, because, does this stock, which has just been a gangbuster uptrend type of name, hold this 50-day moving average like it did back here in February? Now, the difference here is we eliminated a lot of these previous gains in one day. There was more of a sideways time correction to reach the 50-day. This was one day, and we dropped 7+% to get there. This is after being overbought slightly on yesterday's close. So certainly a key name to watch. The ITB, which is a home builder ETF, down a little bit less, 3%, but overall certainly a space to watch. And watch that bearish momentum divergence. We've highlighted these divergences, I think, today, really following through on some of those. We'll have to leave it at Enphase Energy, ENPH. A lot of the this group, renewable energy equipment. First Solar was one of the worst performing names today as well. Enphase strikes me because it really failed to eclipse its December high. Look at how we've now had a couple failed attempts to do so. These last couple peaks were failed attempts to push above the 200-day moving average. That is not a great look for Enphase. I think a chart like this is worthy of our attention when and if, and it's probably more when, it is able to get a foothold above the 200-day moving average. For now, it's pulling back from a descending 200-day moving average. That is not a bullish setup at this particular moment. Folks, that's our market recap. Just a couple quick announcements before we wrap up today's show. First off, we love hearing from you. We love to hear your questions. In particular, we're going to do an all mailbag episode later this week, actually for Friday's episode. And we would love to answer one of your questions in our next mailbag. You can get your questions to us a couple different ways. First off, via email, thefinalbar@stockcharts.com. We're on X at FinalBarSCTV. And here on YouTube, of course, just drop a comment below the video that you're watching on our Stock Charts YouTube channel. We would so love to hear from you. I hope to answer one of your questions in our next mailbag episode. Also, I mentioned earlier the free webcast I'll be doing next Tuesday, March 19th at 1 o'clock Eastern. That's a special event called the Market Top Checklist. We're going to talk about divergences, which is the first item of 7 on the checklist, to get the other 6 and why they tend to be really important guideposts to watch for in this particular type of environment. You're going to want to tune into this free event. You can sign up at marketmisbehavior.com/checklist. Folks, that's it. We're going to wrap the show and go right to the 3 in 3. 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1. I was looking a lot at breadth indicators here, as I often do, but really was focusing earlier today on this breadth divergence. You're seeing the S&P 500 go higher, but I can't help but notice that one of these breadth indicators is actually sloping downward. So from the top, we have the S&P 500 on a closing basis, clear uptrend over the last three plus months. You can see the bullish percent index on the S&P 500 essentially sloping slightly downward, but not too much. It actually has pushed above that crucial 70% level here in the last couple weeks. Look to see if that's able to hold that. And if it does break below 72, that is often a pretty good sell signal according to that breadth indicator. But look at the difference between the S&P trending higher and the bullish percent index on the Nasdaq 100 trending lower. Back here at the around Christmas, sort of end of the year holiday season, we had 90% of the Nasdaq 100 members in a bullish point and figure configuration. Now we're almost below 50%. We're at 54% as of today's close. So clearly trending lower in terms of the breadth in those mega cap growth names, while the S&P is trending higher. Now, given the overweight in mega cap growth in the S&P and the Nasdaq, I do not see this as a particularly bullish signal. I would say that's probably a cause for concern. Finally, just to let you know, the name exposure index was reported. We don't have the data updated just yet, but I checked it. It was just around 104%. And confirming that level, it's actually the highest level we've seen since November of 2021, which was just before a pretty significant market peak. Now, it's worth noting there have been times when we spike above this level, and it's pretty early on, and we go higher. But even when we did get these spikes above 100%, we often get at least a short-term pullback. This is a survey of money managers. It's a weekly survey and asking what their allocation is to equities. This is the first time they've been leveraged long since the end of last year, last week in December. And before that, you have to go back to July of 2023, which is a pretty significant top. And then before that, it's the fourth quarter of 2021. So we've not been leveraged long in quite some time, and not very often we're there. And I usually think of that as a contrarian sell signal. Also, the Ridex flows, which looks at the Ridex fund family and sees whether investors are rotating more to the offensive things like long funds and sector funds versus defensive things like income funds and money market funds. The Ridex fund investors are really the most bullish that they've been positioned since December of 2021. So given the strength that we've seen recently, some of these sentiment indicators are getting pretty overheated to the point that I would argue they're more contrarian bearish than bullish at this point. Folks, that's a wrap for the show. Thank you so much for joining us here on a Thursday afternoon. Thanks for hanging with us as we record the show and to get it to you remotely. We should be hopefully safely traveled back to Seattle, and we'll do our show from Redmond on Monday from our studio. But we'll be doing the show from here today, obviously, and then also tomorrow doing an all mailbag episode. For Stockcharts.com in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a great night.